Welcome to Corporate Finance. Parker and Stone bought land for a new warehouse distribution center 6 years ago for $2.8 million. Now they're going to rent these facilities from a competitor never built. If the land were sold, it would net $3.2 million. Company wants to buy a new manufacturing plant on this land costing $14.3 million. Plus, we have to do $825,000 worth of grading to smooth out the land and make sure the waters flow away from the building. What's the proper cash flow to use as an initial investment in fixed assets? Very simply, the solution is plant cost, $14.3 million, plus grading of $825. We must include the grading. And then the opportunity cost, we include also $3.2 million for a total cost to include in the analysis of $18.325 million. Here's a tricky one that emphasizes the standalone concept. Winnebago is selling motorhomes, 20,000 motorhomes currently per year at $103,000 each, and 14,000 luxury motor coaches at $155,000 each. They want to sell 25,000 new portable campers per year at $19,000 each. This will boost sales of the motorhomes by $2,700 per year and decrease sales of luxury motor coaches by 1,300 units per year. What's proper number to use as annual sales figure in dollars when evaluating this project? Well, the proper way to do it is to do it the way I have included on the right over here, doing it on a standalone basis. Treat this as a standalone project. Do not do what I used to do back in my days as a financial analyst, where I would look at full sales, new total sales minus the old total sales, and get the delta incremental sales. That's the wrong way to do it. So let's go over to the right and do it the right way, where I just take the changes in sales. An additional 2,700 units of motorhomes at $103,000 each gives me incremental sales of $278.1 million. 1,300 luxury coaches less, reduction at $155K, or a reduction of $201,500. And then an additional 25,000 new portable campers per year at $19,000 each, $475 million, for a total standalone project sales number of $551,600. Always treat these new projects as a standalone project. Do not add them into existing sales as I did back in the good old days. You want to treat them on a standalone basis. So on problem number 3, the new project has sales of $515,000, variable cost 36% of sales, fixed cost of $173,000, depreciation of $46,000, and a tax rate of 21%. This smells like a P&L to me. So the equation is sales minus cost equals net income. Sales $515,000, cost a variable cost of 36% of that, or $185,400. Fixed costs are fixed at $173,000. Depreciation expense is $46,000. That gives me EBIT of $110,600. Taxes at 21% of $23,226, and that gives me an NPAT, net income / profit / earnings, as they call it in the Wall Street Journal, of $87,374. And there are your answers to problems 1, 2, 3. In problem 4, we have sales of $704,600, cost of $527,300, depreciation of $82,100, tax rate of 21%. What is the net income? What is the OCF? What is the DTS, or depreciation tax shield? D times T. So my equations are sales minus cost equals net income, OCF equals EBIT plus D minus T, and tax shield is D times T. I could easily also check this really quickly by, since there's no interest expense, I could check the OCF by taking NPAT plus D. So sales, that sounds like a P&L. To do the OCF, I need a P&L, or an income statement. Sales are $704,600. Costs are $527,300. Depreciation expenses $82,100, leaving me with EBIT of $95,200. Taxes at 22%, or is it 21%? Let's take a look at that. 22%. So up above in the givens, it should say 22%. MPAT is $74,256. And then my OCF is EBIT plus D minus T. And I get $156,356 for OCF. And depreciation tax shield is D times T, which is depreciation times tax rate. And so that is D54 times 0.22 or 18,062. And problem number 5, in 10.5, we have a new project with sales of $215,000, cost of $104,000, depreciation of $25,300, and a tax rate of 23%. Calculate the OCF 4 different ways. The first thing I have to look, is there any interest expense in the givens? No, so I can use all 4 methods. Traditional, bottom up, top down, and tax shield. So I build my P&L vertically first, all the way down to swoosh, swoosh. $215,000 of sales, then cost, less cost of $104,000, less depreciation expense of $25,300 gives me EBIT of $85,700. Taxes are at 23%, and then I get MPAT of $65,989. Swoosh, swoosh. I first go to the traditional method, which is always safe to calculate OCF. Can't go wrong. So if you're ever wondering, just do it traditional way. EBIT, $85,700 plus depreciation of $25,300. I have to add it back because it's a non-cash expense, and then less my taxes of $19,711. That gives me an OCF of $91,289. No matter which method I use to calculate it, I should get the same answer. So bottom up is simply, again, there's no interest expense in that P&L or income statement. And so I just take the net income, $65,989, plus depreciation, $25,300, and I get $91,289. Top down is very simply sales. $215,000 minus cost, $104,000 minus taxes, $19,711, giving me the same OCF of $91,289. And using the tax shield approach, I take sales minus cost of $111,000, and that number times 1 minus the tax rate, or 77%, plus depreciation of $25,300 times tax rate of 23%, and I get the same OCF of $91,289. So each way, I can use all 4 methods as long as there's no interest expense. Only the traditional method if you do see interest expense in that P&L. And in number 6, we have equipment that costs $1.475 million, brand new, 7-year MACRS class. Calculate the annual depreciation, the total depreciation, and the ending net book values. So we go into the tax tables and we get the annual depreciation amounts for 7-year MACRS. Note that we have 8 years. Note that we have some goodness in the second year, some accelerated depreciation in the second year, and then some extra depreciation in the 8th year. Even though it's a 7-year MACRS project, we're allowed to go 8 years according to the IRS. So I just simply take each of these percentages, which should add up to 100%. There's your first checkpoint. In case you might have transposed a number here, you want to be careful and make sure these all add up to 100%. If they do not, go back to the table and put the correct numbers in until they do add up to 100%. Then I'll multiply each of these percentages times the cost of the equipment, 1475000, to get the annual depreciation amounts. Also, another checkpoint number 2 is these should add up to the cost of the equipment. Again, if you've depreciated it properly, by the end of the 8th year, according to the table, I should be fully depreciated. And looks like I am. And then I put a third check column in there to get the ending book value. And I just take, to get the end of the first year, I take the original cost of 1475000, subtract the depreciation of 210,77750, and I should get the ending book value that I show here. And then just zigzag down. Take that number, 126422250 minus 361 to get the 902, then 902,995 minus the next depreciation amount, and so on all the way down. And if I've done my depreciation correctly, I should get an ending book value of 0 at the very bottom of the table in year 8. And there are your answers to 4, 5, 6. In problem 10.7, an asset cost $745,000 is depreciated straight line to 0 over 8 years. Asset will be used in a 5-year project and can be sold at the end of 5 years for $135,000. So this is a straight line depreciation problem, like the last one, which was MACRS. Tax rate is 21%. What is the after-tax cash flow from this project. So the asset cost, the equation is take my asset cost and divide by 8, which will give me annual depreciation of $93,125. Once again, let's do our checks. All the depreciation percentages should add up to 100%. They do. The depreciation dollars should add up to the cost of my equipment, $745,000. And then I just start with my $745,000 and take away $93,125 to get $651,875. Take that minus $93,125 to get $558,750, and so on down. And I should get, again, an ending book value by the end of the 8th year of 0. If I want the after-tax cash flow, I take the ending book value, which at the end of year 5 is $279,375 less the price I sold the equipment for, which is $135,000, and see if I have a loss or a gain. It looks like I have a fairly big loss of $144,375, and the tax on that loss is about negative $30,318.75. So I get a tax savings or a tax credit from Uncle Sam. So the cash that will come in, my after-tax salvage value, will be the $135,000 selling price plus the tax savings of $30,318.75 for a total after-tax salvage value of $165,318.75. There's your answer to problem number 7. In problem number 8, I have, this time I'm back to MACRS. I have another MACRS project, 5-year, acquisition cost $5.7 million. I can sell this equipment for $1.8 million at the end of year 4. My tax rate is 21%. What's the after-tax salvage value? Once again, we're going to build our MACRS table using the 5-year MACRS percentages. Note that I get a little goodness in year 2 and I get some goodness in year 6, which wouldn't happen with straight line. Check number 1, make sure all of my percentages add up to 100%. Check number 2, make sure my depreciation dollars, so I basically take 0.2 times 5.7 million, 0.32 times 5.7 million, and so on down. Make sure my total depreciation adds up to the cost of the equipment that's fully depreciated, and I add them up and I get $5.7 million of depreciation, so it is fully depreciated. And then I take my $5.7 million minus each of these depreciation dollar amounts. First one, 1140000, gives me 4560000, and take that minus 1824000, and I zigzag on down the whole table, and I get 0 for ending book value by the end of year 6. So again, 5-year MACRS gives me 6 years of depreciation. We might call that a bonus year of depreciation. And what is my after-tax salvage value? Well, I sold the equipment for $1.8 million. At the end of year 4, I check my ending book value here, and it's worth $984,960. So in this problem, I have a gain, $815,000. Selling price above my book value. Market value above book by $815,000. Whenever you make a gain in life, Uncle Sam wants a tax on that gain, and that tax is at 21%. Tax will be, so my gain will be reduced by, or the selling price will be reduced by my taxes, and that tax again is $171,158.40. So I take my selling price minus my tax on the gain. So I won't get the full $1.8 million because I'll have to pay tax on it. I will get an after-tax salvage value of $1,628,841.60. Another way to look at that, I can take the ending book value of $984,960 plus the after-tax gain, which is the gain minus the taxes of $643,881.60, and I get the same answer of $1,628,841.60 for after-tax salvage value. In problem number 9, I have Esfanda Erie Enterprises considering a 3-year expansion with initial fixed asset investment of $2.18 million. Depreciate this straight line to 0 over 3 years. This project will generate $1,645,000 in sales, cost of $610,000, tax rate of 21%, and they want to know what is my OCF. And as we all know, to do any OCF calculation, I need to build a P&L or income statement. So in this P&L, we have sales of $164,500, cost of $610,000, depreciation expense of $726,667. That leaves me with EBIT of $308,333. I tax that at 21%, and I get a net income number of $243,583. calculate the OCF, any of the four methods. There is no interest expense in that P&L, so I can use any. I'll use the traditional approach, and maybe I'll check it with the bottom up. So traditional tells me EBIT 308,333 plus D 726,667. I must add it back because I subtracted it out. So to get OCF, I need to add it back in. And then I take away taxes of 64,750, and my cash flow from operations, operating cash flow is 970,250. I can check that number by taking bottom up because there is no interest expense in this P&L. So I could take 243,583 and add it to 726,667, and I should get 970,250. There is your answer to problem 10.9. In problem 10.10, we get back to 10.9 and we say if the required return is 12%, what is the net present value? So minus the first, the formula is minus the first cash outflow plus all those discounted cash inflows coming back in. But I must take the 970,250 found in problem number 9 and discount it. We're going to discount the first one by 1.12 to the first. We're going to discount the second one by 1.12 squared, and we're going to discount that third one by 1.12 cubed. And if I add all four of those cash flows up, the first initial cash outflow plus the discounted cash inflows in the row below, so minus 218,000 plus 866,294,64 plus 773,47736 plus 690,604,79. Add those all together and I get a net present value at 12% of 150,376.79. In problem number 11, we're going back to 10 again, and we're going to say, well, in this case, we have net working capital requirements of 250,000 at time zero in addition to the 2.18 million to buy the equipment, and the salvage value at the end of the project is 180,000. That's before taxes. So we need to calculate after-tax salvage value. So once again, I create a table, and very simply, this is the same as the last problem where the NPV is minus initial cash outflows, plural, because now we see two of them, plus the discounted cash inflows, including the after-tax salvage value. So at time zero, I have an outlay of 2.18 million for the equipment plus 250,000 for the net working capital. It's an outflow. So my total outflow is 243,000. As we had in the last problem, undiscounted, I got 970,250 of OCF for 3 years. In the third year, I'm also going to reverse that 250,000 sign and recapture my working capital, 250,000. And then for the after-tax salvage value, I won't get 180,000. I'll get 180,000 less the taxes on that. So I'll take 180,000 times 0.79 because 21% will be taken away in taxes. So I'll only get 142,200. Now I summarize all those cash flows. And then below that, I'm going to discount them. So I take the 970,250 divided by 1.12, the 970,250 by 1.12 squared, and the 136,250 divided by 1.12 to the third. And at 12%, I have add them all up. The minus 2,430 plus the discounted cash inflows, three of them. I get a net present value of 179,537 at 12%. Accept, because it's a positive NPV. And in problem number 12, we're going to look at putting this project. What happens if we put this project in a 3-year MACRS asset class versus a straight line? What are the new cash flows? What is the new NPV? So once again, NPV is still cash outflow initially today, cash outflows because we will have working capital also, and then adding back the discounted cash inflows. So we need to build 4 years of P&Ls. If it's in the 3-year MACRS asset class, we'll go all 4 years, and I'll build a P&L with the sales, the cost, the depreciation expense, and the net income. And note that the depreciation expense goes up. It's not just straight line. So it goes from 726, and then we get a little bonus in the second year, and then we get a little goodness in the fourth year because it's 3-year asset MACRS asset class, 3-year, but it goes for 4 years with a bonus in the second year, a higher amount than straight line, and nice little bit there in year number 4. So there are my P&Ls with my net income numbers calculated, and then from that I can use traditional approach, EBIT plus D minus T, to get the OCFs. These are undiscounted OCFs. Bring them down to basically my CFFA table, and here is my net capital spending, here's my change in net working capital, and here are my 3 OCFs that I just pulled down from above. And now I'm going to want to add all these things together and then discount them. So at time zero, I have the equipment price of $2,180. I also have $250,000 going out in net working capital. I'm going to reverse that sign in year 3. And then finally, I have to calculate my after-tax salvage value. If I sell this for $180,000, I have to go up and see if I have any residual depreciation. And it looks like I do. So it's still on the books at the end of year 3. For $161,538, so I must take that into account, and I take the $180,000 selling price minus the book value of $161,538 times 21%. So that's after-tax gain that I'll make on this project. I sell for $180,000. It's only left on the books valued at $161,538. So I make a gain there about $18,500, I guess that is about $18,500, almost $19,000. But that gain will get taxed to the tune of 21%. So my after-tax salvage value to take into account is $176,122, not $180. And then I come with my 4 undiscounted cash flow numbers. And then I discount the last 3. The first one, obviously, there's no discounting because it's today. I take the 970,234.74, divide that by 1.12. I take the 1,021,142.10 divided by 1.12 squared. And I take the 131,157,316 divided by 1.12 cubed, and I get 933,551. Add up these 4 cash flows, minus 243,000 plus 866 discounted 281, plus 814,048 discounted year 2, plus 933,551 discounted year 3, and I get a net present value on this 3-year MACRS project of $183,881. And again, that is an accept decision because it is a positive NPV. And there are answers to 10, 11, 12.